Hey guys, so basically I just wanted to make this video to discuss an ETF that's been popular among the dividend community. So we got here TSLY, which is an ETF that basically buys, puts and calls, and writes calls against them to generate premium, which is then given out as a dividend. And you can see here that these supposed distribution rates are pretty attractive, and I'm going to be covering TSLY today, which is this one right here. So this TSLY one is the most popular, so I'm going to be covering that one today. So you can see here that, like I just said, they use a synthetic covered call strategy, which is where they buy calls and puts, and they write calls against them. And you can see here that they like to do them about 5 to 15% above their current share price. So for example, if Tesla was at $100, they would write a call at maybe the $105 or $115 strike price. So basically, when you're writing a covered call, you're essentially capping your gains if the underlying stock rises too much. Okay, so you can see here that as the stock price increases, your gains at a point, which is the strike price, they essentially get capped. All right, so that's because you have to sell at the strike price if the stock is above it at expiration. Now, the other thing to note with TSLY is that you're not an actual shareholder of Tesla. So you can put $10,000 into TSLY and say, "Oh, I'm a shareholder," but you're actually not, because you're basically just buying a derivative of Tesla, which is the call input, and then the call that they're writing against it is how they're making their money for you. Okay, so you're not actually an owner of Tesla, which is kind of depressing. And so the other thing I wanted to say is that when you're also writing a covered call, you want the share price to be stagnant so that you get the full premium without having to sell your shares if it breaches the strike price. So as you can see, the thing with Tesla is that most of the time it's going up. Okay, you can see here and here and here it goes down here, but most of the time it is increasing. So that's a drawback, and it's pretty much tells you that you're not going to beat Tesla over the long run, because first of all, Tesla doesn't inherently have a dividend to pay out to its shareholders, and that can be seen as a good thing or a bad thing, because when you don't pay a dividend, you have the opportunity to reinvest your revenue into your own company to grow your share price and continue to grow your revenue in the future. Okay, so I pulled up here a back test of Tesla versus TSLY, the covered call ETF, to compare the two portfolios. So you see here I assigned Tesla 100% portfolio 1 and TSLY 100% of portfolio 2. So you can see here, we put $10,000 in each of them, and we're reinvesting the dividends so it's fair towards TSLY. And since Tesla's only been out since November of last year, we're only comparing year to date, which is the start of 2023. So see here that the blue line represents Tesla and the red one represents TSLY. So by looking at the graph, you can see that Tesla does outperform TSLY as we suspected. Now, it's important to note that when Tesla does have a drawdown, TSLY will make a comeback towards Tesla. So TSLY may outperform Tesla in a bear market, but like I said, the majority of time, Tesla and these growth stocks will be increasing, and I suspect that Tesla will increase past the $400 mark in years to come. All right, so that's one thing to note with this. So you can see here that the $10,000 you invested into Tesla will grow to $21,000 just based off of the last few months. And TSLY's $10,000 investment only grows to $17,000. So I would be cautious when investing in TSLY. I think TSLY could be a good investment for people who are maybe retired and want to start living off the dividend income without selling their underlying shares. Another important thing to note is that your expense ratio is extremely high with TSLY, almost 1%. Now, what the management ratio is, or expense ratio, is basically what cut of the ETF manager gets to manage the ETF itself. So you can basically just subtract 1% from your overall gain at the end of the year, and that'll be a more accurate representation of what you actually got out of your investment. So another important thing is that you're going to have to pay taxes on these dividends, which the good thing is it's a qualified dividend, so it's not an unqualified one, so you're going to get preferred treatment with these dividends according to the IRS and stuff. But it's still a tax that you wouldn't have to pay if you just invested into Tesla itself. So that's something to know as well. So just to close the video out, I would just recommend either if you're in retirement, TSLY may be a good option for you if you just want to live off the dividends and not sell your shares. Or you could potentially just buy 100 shares of Tesla itself and then write covered calls yourself. And that way you don't have to pay the taxes or the expense ratio. And you actually get to say that you're an investor in Tesla. So, I mean, yeah, just reconsider if you actually want to buy any of these. And yeah, that's all I wanted to say. See ya.